Ladies and gentlemen, good day and welcome to the Indian Hotels Co Ltd earnings conference call for the quarter and financial year ended 31st March 2024. On the call we have with us today Mr. Puneet Chhatwal, Managing Director and CEO, IHCL, Mr. Giridhar Sanjeevi, EVP and CFO, IHCL, and Mr. Ankur Dalwani, CFO Designate. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Puneet Chhatwal. Thank you, and over to you, sir.
Good evening, everyone, and thank you for joining our global conference call for Q4 and FY23-24. Today, we would like to focus on 10 key messages summarizing our performance, journey over the last financial year, and expectations for the future. Firstly, achieving Ahvaan targets or achieving key Ahvaan targets ahead of time. We embarked on a journey in 2022 wherein we set specific targets under our Ahvaan 2025 strategy. We are pleased to share that we have already achieved our key objectives well ahead of time. We aimed at achieving EBITDA margin of 33%, and we have delivered EBITDA margin of 33.7% in last financial year. We promised a portfolio of 300 hotels, and as of 31st March, we have achieved a portfolio of 310 hotels, including 90 in pipeline. Our third objective of achieving zero net debt level had been achieved long back, and in fact, we have now surplus cash reserve of over 2,200 crores. Furthermore, we had promised a balanced portfolio, and now we have achieved a 60-40 mix of capital light versus capital heavy assets. And to summarize on the first point, we promised and we have delivered on all fronts. Number 2, best ever Q4 and full year financial performance. We are very pleased to share that our record performance has continued in Q4, making this the 8th consecutive quarter of best ever performance for IHCL. Our consolidated revenue grew 17% year-on-year to 6,952 crores. EBITDA grew 20% year-on-year to 2,340 crores, yielding EBITDA margin expansion of 100 basis points to 33.7%. More importantly, our bottom line grew by 26% to rupees 1,259 crore. On the standalone basis, we continue to deliver stellar results with revenues growing 20% year-on-year to rupees 4,590 crore and EBITDA margin expanding by 200 basis points to 41.3%. Some of you would recall pre-COVID, our consolidated revenue was lower than what we have as standalone revenue in the last financial year. That brings me to point number 3. We delivered manifold increase in return ratios. We have delivered superior returns both in terms of return on equity and return on capital employed in the last 6 years. For that, since we began our journey with Aspiration 2022 strategy, since 17-18 for that matter, our ROE has increased 7x to 14% and ROCE has increased 3x to 15% in FY23-24. Moreover, IHCL's EPS has increased 11x from rupees 0.8 in FY2017-18 to rupees 8.9 in FY23-24. Fourth, market leadership. IHCL continues to outperform the industry on RevPAR with a premium of 65% over the competition on pan-India basis. With presence across various price points, our hotels command healthy premiums over the industry in all key markets. We have around 100 hotels in the top 7 cities with diversified presence across customer segments and price points. We are well positioned to capture the surging spiritual demand with presence in 50+ religious or spiritual destinations. Number 5, our portfolio growth. We continue to demonstrate industry-leading growth with 53 hotels and 34 hotels opened during FY23-24. This is the highest in any single year done by anyone. More importantly, with 218 hotels operational and 92 in pipeline, we crossed the milestone of 300 plus hotels portfolio. IHCL entered into a strategic alliance with the Muja Neotia Group's tree of life resorts, offering our sales and distribution network to its portfolio of 14 resorts across the country. Just for the sake of clarity, when I said this is the highest done by anyone, it is based on organic growth and it is based on the pan-India figures and not the global figures. Number 6, unique mix of capital heavy and capital light. Our current operational portfolio has a balanced mix of 60% capital light and 40% capital heavy assets. The capital heavy portfolio drives operating leverage and has demonstrated strong growth on the top line, but more importantly at the EBITDA level on the back of effective asset management and strategic addition of new hotels. On the other hand, capital light portfolio provides resilience. Our capital light businesses comprising mainly of management fees and new and reimagined businesses currently contribute roughly 14% to consolidated revenue, and in the near future, contribution from this high margin portfolio is expected to increase to 20% of consolidated revenue, which in turn will drive margin expansion for the overall business. Number 7, new brands and reimagined businesses. IHCL's new businesses vertical comprising of Ginger, Cumin, Ama Stays and Trails, The Chambers, and the reimagined TajSATS reported a revenue of 1,600 crores. Obviously, this does not include the revenue of TajSATS, but of the other verticals that I just mentioned. At a growth of 35% over the previous year, new businesses grew at double the pace of core IHCL enterprise, which grew at 17%. New businesses now account for 12% share of IHCL enterprise revenue, showcasing an expansion of about 150 basis points from the previous year. Now I come to TajSATS. TajSATS clocked a revenue of rupees 900 crores at 40% growth over the previous year, with a market share of almost 60%, maintaining an industry-leading EBITDA margin of 25.5%. Ginger reported a brand revenue of rupees 486 crores, growing 34% over the previous year, aided by the flagship Ginger Mumbai Airport Hotel, contributing over rupees 25 crores in the first full 4 months of operation. Ama Stays and Trails achieved a portfolio milestone of 200 homestays, bungalows, with 103 added in the last financial year. So, Cumin brand also achieved a milestone of crossing rupees 100 crore in its GMV or brand revenues in FY23-24. Finally, IHCL will also introduce a new brand as we announced in the last call. This is our reimagined version of Gateway, a full-service hotel offering in its new avatar in the upscale segment. This will be a similar story like the Ginger, which was reimagined in the years 2018 and 2019. The Gateway brand rollout will commence with 15 hotels and will scale to 100 by 2030. Number 8, strengthening competitive advantages. We remain committed to investing in our assets and building our capabilities for the future, thus strengthening our competitive advantages. IHCL in FY22-23 commenced a 5-year capital deployment plan of over rupees 3,500 crores towards asset upgradation and select new strategic investments. This includes strengthening of our digital capabilities with new brand websites, implementation of new ERP system, and data lake for advanced analytics with AI and ML capabilities. Some of these launches, especially of the new brand sites, you will start seeing from the first week of May onwards. That means in 8 days from now. Number 9, Pathya, our industry-leading ESG Plus program. We have achieved significant milestones this year on our ESG Plus program, and IHCL now uses 37% energy from renewable sources and has installed 343 EV charging stations across 142 locations in India. Continuing our journey of eliminating single-use plastic, IHCL has installed 40 bottling plants and achieved 48% recycling of the water that is used. IHCL also partners and operates 32 skill centers today across 15 states in India. Finally, maybe the most interesting for all of you, what can we expect going forward? And rightly, it's the number 10 on the list. We feel that the hospitality industry upcycle is expected to be a long and sustained one. Of course, every now and then there will be some headwinds and some drops, but eventually nothing better than COVID can, give the proof of the resilience of this sector. So accordingly, also experts like Horwath HTL have predicted that demand will grow at a rate of over 10% annually for the next 3 to 4 years, while the supply will continue to lag demand. Most of the future supply is expected to come outside of the key markets or non-tier 1 cities. We are very much, as IHCL, in sync with what Horwath has been guiding. Within the IHCL context, we expect to deliver consistent double-digit top-line growth, therefore, with sustained margins and continued portfolio growth, with a target to open 25 hotels in FY25. We had guided 20 for last fiscal. If we include Tree of Life, it's 34. If we exclude that, it's 20 hotels opened as we had guided, and we are very much confident of opening a minimum of 25 hotels, and that's the guidance we are providing. Our new business will continue to grow also over 30% in the next fiscal, which last year was at 35. As the base gets larger, the guidance you can expect will be in the range of 30 now, and going forward maybe at 25%. Our focus also remains on evolving our brandscape and strengthening our competitive advantage with extremely prudent capital allocation in strategic opportunities. However, we are very well positioned with the cash position that we have, with the zero net debt that we have, to take advantage of any strategic opportunities that might come our way. Our new dividend policy has been approved by the board, and we have proposed to declare dividend at a payout ratio of 20% of consolidated PAT, for that at rupees 1.75 per equity share at 175%. This is subject to shareholders' approval, as we all know. Thank you so much for your attention, and we now open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Binay Singh from Morgan Stanley. Please go ahead.
Hi team, thanks for the opportunity. One clarification and one question. Just on clarification, on slide 51, when we talk about 4% ARR growth, this I assume is including Ginger Mumbai Airport, right? So which is why the number looks lower than what it was 2 quarters back.
One second, Binay, we are looking at it. So occupancy is that ARR. Yes, it includes all brands. Not just Ginger, but all brands.
Yeah, it includes Ginger Mumbai Airport.
Then also, no, sorry, it's only Ginger Mumbai Airport in standalone. So yes, it includes Mumbai Airport.
Yeah, because that would have to an extent diluted the room rate growth.
Yes.
And secondly, just slide 47. If you look at the Taj business, we are breaking it into business, leisure, and palaces. Could you give us a little bit of a revenue breakdown also on these three segments? And question B linked to that, where do you see more scope for occupancy improvement or room rate improvement among these? Where do you see a pushback? In quite well, so incremental opportunity to expand occupancy or room rate looks limited. So that's the second question. Thanks.
Vinay, there is a nominal increase that you expect every year, but very important for us and our portfolio is our not like-for-like growth. And with a company growing at the speed at which we are growing, also the new openings dilute that percentages that you see. See, it's not just the Ginger Mumbai Airport in standalone, but if you take the overall picture, then even if it says like-for-like, for example, it takes 3 years normally for a hotel to stabilize unless it's opened in extraordinary circumstances. So, established property, let's say like Taj Lands End and Taj Mahal Palace in Colaba, will have a different kind of increase versus, let's say we have opened Taj Trees in Mumbai. There is a ramp-up period. So with this high growth, in one way we are doing it because you all like to see these percentages, but maybe we need to show it differently going forward, saying what is it for hotels that have been in operation for a minimum period of 3 years? And how does that percentage growth look and how does the new one look? So the new one helps you that when the headwinds come, they're all adding because most of that is on capital light. But it comes at a disadvantage that it dilutes the figures because technically we include all hotels which have been in operation for a minimum period of 1 year.
And then I think to your previous point, if you were to exclude GMA, the ARRs would have grown by about 8%. This is on the previous question that you had. So because of the GMA, obviously the averages have come down.
Yeah, no, I think thanks for that. And Puneet, I think your point is very relevant, especially when you look at the pipeline ahead also. We will see a lot more management contracts coming in. So to an extent, I think this slide in particular will look a little diluted. But last question, any commentary on the near-term trends, like how are you looking at demand in this quarter, April-May quarter? I understand sequentially it is weaker, more on YOY basis. How do you see?
What we are saying is what we believe in. We think that top line double-digit growth is what we feel is going to happen. Now, if in one quarter is in 9% and in the next one is 11, still the average would be 10. So I'm not saying it's 10. It could be 11 and 13. So I think anything which is north of 10 on an average for the year, we feel is a realistic number going forward because again, that base has become larger. To keep doing 18, 20, 22% growth is possibly very aspirational and ambitious. It's not impossible, but is aspirational and ambitious. So anything which is north of 10 gives us a very good platform on all metrics that I mentioned while giving those 10 important points.
Great. Thanks for that, team. I'll come back in the queue.
Thank you, Binay.
Thank you. The next question is from the line of Achal Kumar from HSBC. Please go ahead.
Hi. Thanks for my question. Thanks for taking my question. So first of all, Puneet, just wanted to understand about MICE business. So, so do you think the MICE business has normalized and back to pre-COVID levels, or you think there have been few structural changes, i.e. bigger conferences, fat marriages, and which are significantly positive, and do you see a sustainability there? So if you could please give us a bit of a color in terms of MICE business, especially pre-COVID now versus now.
See, in our estimation, this business is kind of grown by 17%. Of the share of revenue for our business is 17%. But I think India is going through a structural change. We have not even reached 5% of the possible MICE business by just the addition of Yashobhoomi in Dwarka and Bharat Mandapam in Pragati Maidan and the convention center in Kolkata, and the one which is ahead and getting more close to doing well is Jio in Mumbai, right? So I think taking the MICE out of the hotel business, because when you have events where 2,000, 3,000 or more people could come in one single hall, that kind of infrastructure never existed. So this is opening a big new opportunity. In terms of weddings, that is maybe a speciality on the Indian subcontinent and is going to stay a very important element of the culture and of the culture of celebration or as a culture of social gathering. And we are seeing no change when it comes to weddings. There is nobody worried about going into a hall because there was COVID. I think all that fear is gone. People are back and meetings are happening in a normal way. But what we have not yet seen is global events coming to India. We recently hosted in the month of February the global conference of Coke as an example. Or, 8-9 months ago, I don't remember the exact month, we had the launch of the new Dior collection at Gateway of India. So you will start seeing, or India will start seeing and witnessing more and more of these events. And hopefully as the largest hospitality ecosystem, we continue to benefit from it, and it's not a one-off like a G20. But also a G20 has created the infrastructure which will benefit hospitality sector going forward. And Achal, maybe one simple answer here is not only it's gone back to what it used to be, it has improved. And when it comes to new facilities, we are not even at 5 to 10% of possible utilization.
Right. Fair enough. Very clear. Other thing I wanted to understand, you just spoke about the gateway hotels, and you mentioned that you're going to have 15 hotels and probably end up by 100 hotels by 2030, if I understood correctly. So, what is the logic? Why you want to have another brand, and how you think you want to position it within your existing Taj Selections and Vivanta and all. So where exactly you see this gateway hotels to be placed, and what is the logic? What kind of benefits do you see? What synergy do you see?
Excellent. Very good question, Achal. I'm glad you asked it. See, Taj, we have worked a lot on the last 5 years in upgrading and investing in Taj, and rightfully it got acclaimed as India's strongest brand across all sectors by Brand Finance, and also world's strongest hotel brands for, in the last 3 years. And this year the verdict is going to come in June. Now, Taj is and was always a luxury positioning. Somewhere it got diluted for whatever reason 20 years ago when we added by Taj in Vivanta, and the gateway hotel had become Taj Gateway. So when we started the journey of Aspiration 2022, we put the gateway brand in the drawer, and we always communicated and guided. We will bring it out, A, when we have the critical mass in the brands, B, when we have clarity on the brandscape and how an evolution in India could take place, C, when we feel now is the moment, and that's what we feel is now, because your tier 2, tier 3 cities cannot afford a Taj, as the cost to build a Taj and your ability to charge are not in sync. So if you look at the press release that we have given and the destinations that we have given, doing a Taj hotel there would be a challenge. At the same time, we reimagined Vivanta 5 years ago, and we said Vivanta is what it was supposed to be. We want something which is very chic, very boutique-ish, and that is not a brand that will fit into, let's say, every possible location like a Karnal or a Barnala or etc. So these are the tier 2, tier 3 cities which are coming up very strongly. And that's the ethos and the style of the brand is done in such a way, including its uniforms, that it would not fit in such destinations. Plus, we have limited Vivanta with banqueting spaces. We don't want to have too much wedding and all that kind of business, because either you're a mass brand or you're a chic brand. You cannot be both. Now, SeleQtions is very easy. It's a collection of names that are a brand in themselves in their relevant marketplace. For example, the President in Mumbai is a part of SeleQtions. The Connaught in Delhi is a part of SeleQtions. The Ambassador in Delhi is a part of SeleQtions. The Blue Diamond in Pune, the Savoy in Ooty. These are all names which are very well established over several decades, if not a century. So I think this was a gap that we had, but we had not reached 100 Taj hotels and we were not close to 100 Ginger. Now that we have crossed in the portfolio 110 Taj branded properties, and Ginger in the next few months should get close to 100, it's already at 90, is the time to launch this brand, which will be upscale, full service, and a gateway to that city. It will be a very regional brand which will have all the important characteristics of that city. So gateway in Nasik will represent in its artwork, in its style, in its arrival experience, a Nasik. A Bekal in Kerala will represent Kerala. So I think this way we go out and become a very good, in a traditional world, we would say, a very nice 4-star full service brand. And in a modern world, we would say it's an upscale full service brand. And we are also launching it because we are very confident of getting quickly to a critical mass of 50 hotels in operation and a portfolio of 100 very soon. And we start with 15. We already start with double digit. We're not starting with something you build one hotel at a time and it takes another 20 years to get to the 20, 30, 40, 50. And that's why we have given the list in the press release of the names of the properties as well as the quarter of their opening. I hope this clarifies some bit. The rest, whenever you visit us in our office, we can show you on a chart.
No, that's very interesting. Very, very interesting. I think that's a great idea. Thank you so much for giving the clarity. My final question, if I may, please. If you could please share a bit of a plan in terms of your capex, which you mentioned that 35 billion, and you already spent 10 to 11 billion, so which means you're going to spend additional 25 billion in the next 3 years, especially on the digital and IT spends. And are you collaborating with the broad Tata Group, especially in terms of airlines? I mean, they have Air India and all. So I've been thinking about this. Recently, I could see very surprisingly, Indigo quietly launched a link on their website where you can book the hotel. So do you have that kind of plan wherein you are collaborating with Air India and they can sell the holiday business wherein they can get the link? So I mean, just want to understand your close collaboration with Tata Group and your plans on the digital IT spend. How do you see the benefits from there?
We are a Tata Group company and we always look at synergy possibilities with all group companies and not just airlines. But you are right, because somehow airlines, hotels, flight catering, all this go together. So that part is there, but I think there was a lot of work to be done on Air India. They are getting close to a lot of initiatives that they had taken, and during the course of this financial year, we will try to align ourselves on strategic fronts. But maybe you should be asking this question again in a couple of quarters. But that does not mean we don't collaborate today. We do collaborate. We went out and built a Maharaja Suite at Taj Mansingh. We do wherever we can meals for them. We are doing almost all meals for Vistara in whatever stations we are, except for Hyderabad. So there is a lot of that collaboration that is already happening. It's not that is not there. And I think if Air India was to join the loyalty platform of Tata Neu, that